Hi everyone, my name is piterpakulski. Today we have a final overview of a financial model of a vending machines. If you find this video valuable, you can give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. Today I will show you what parameters may affect simple discounted payback period, may affect cash flow statement of vending business idea. So let's start. First of all, we have a unique rule through all of our models. So blue cells are our inputs, all other cells are automatic, they are formulas. So first of all, we set up when we start the first year of our projections. So this is the first input. Then we create the block of coefficients for pricing, direct expenses, investments, amount of customers, fixed service expenses, asset tax. This will allow us to play with with revenues, expenses, investments very quickly to create numerous amount scenarios. So here we have counted payback period diagrams. Here we have revenues, expenses, profits, profitability. Here we can see the internal rate of return calculation. We are setting up the discount rates here, the step of changing the discount rate, and here we have the sensitivity analysis. That will be our the last step of video. So done with the cash flow statement, you see how much financing you need. You just start playing with all these coefficients, going from the top and diving deeper to your inputs. So this will allow you easily play with the inputs. But with playing with coefficients is much more easier than playing with the values of the inputs themselves. So first to find the better business concept, you will be playing with these coefficients. So, and here they are. You can start adjusting them after you see the cash flow statement, see the results, how much financing needed, and so on. So then we have different portraits of vending machines. So our vending machines, so let's say we have 20 types of vending machines. They may differ by model. They may differ by the place where they stand. For example, some of them will stay in the airport, some of them will stay in office buildings, some of them will stay in for example, malls, shopping mall, or in somewhere outside. So so we are setting up what is the portrait of this vending machine. Then we can switch on and off each vending machine type portrait from our calculations to see the how cash flow statement will perform with or without this or that vending machine type. Then we specify every check for each vending machine type. Then we have a coefficient for every check to make us easily play not with these numbers but to see what will happen if I increase or decrease the average check on 20% or decrease it by 30%. Then we have the direct expenses level from our average check. Then we have also the coefficients for direct expenses, investment plan for each vending machine. Then we also have coefficient to investment plans, because we will also be able to play with all this stuff without adjusting these values. Then we have some service expenses, coefficients to service expenses. Then we have some periodic expenses depending on which type of vending machine we have. So this is the level of expense, and this is the period when this expense occurs. So for example, we pay $50 once in 3 months. This will be one service expense for this vending machine type. We also have another type of periodic service expense. So we pay $23 once in 6 months period, and so on. So we have different service expenses, and for them we can specify not only the values but also how often we pay this or that expense. Then we specify the asset tax for each vending machine. We also have coefficient for asset tax, so we can switch on, switch off this parameter. Then we move to the revenue parameters that affect the cash generation algorithm. So first of all, we just here we have different portraits of our vending machines. So here they are. These portraits are here, and then we have the typical week, and then we specify how many customers we have each day inside the typical week. Because, for example, in airport, it will be 24/7. In office building, this will be only from Monday to Friday, and so on. So we can specify different portraits of customers for each vending machine type. So we are now describing the types.
Then, for example, we may also have some functionality for customers. So, for example, in summer we may have some decrease in customers, and in winter we may have some increase. So here we specify in percentage
The level of
seasonality for different types of vending machines, depending on where they stand, their locations.
Then we specify. Then we also have seasonality coefficient for all types of vending machines. Then we specify how fast we reach the planned revenues, the planned amount of customers. For example, these vending machine type can reach it very slow. Some of them will be, if we put them inside the airport, they will reach the 100% of revenues just from the first month, right from the first month. So here we can specify how fast we are reaching the planned amount of customers. Then we have a core where we specify, so we have in this core we have 200 vending machines. Here we can specify the portrait. So earlier we were describing the portraits of these vending machines, and here we can specify the portrait of this vending machine, and all the parameters that we've already created for this portrait will be linked here. So we're just specifying what kind of vending machine we are setting up in this location. We are switching on and off this vending machine. This is for scenario modeling. Then we specify when we start operating activity of this vending machine, and that's it. So this is quite convenient. So here we have 200 vending machines, and here we specify when we start operating activity. We can switch on and off each vending machine from calculation, so we can work with two machines very easily. Then we have then we describe direct payroll, depending on how many so here we specify the salary of a person, and then we specify the amount of vending machines per one person. So we hire one person on this position every 40 vending machines in our operating activity. So if we have 40, we have one person. If we have 42, 41, 43, 50, we will have two people on this position. If we have, for example, 82 vending machines in operating activity, we'll have three people on this position. So here we specify how many people, how many vending machines per one person on each position we need, and then we automatically figure out the amount of people on different positions that we need, which we need to operate all the vending machines inside our business model. So then we specify direct expenses per one vending machine in operating activity. So for example, if we have two vending machines at this time, we just multiply 12 on 2. If we have 20 vending machines in our operating activity, we'll be just multiplying 14 by 20. So it depends on how many. So these expenses, so we just take the current amount of vending machines in our operating activity and multiply it on these different costs that affect these direct expenses. Then we move to management company. So here we specify what we invest in. Here we specify the price per unit that we're investing in, and here we specify how many units we are buying to inside this investment stage. And here we get the totals for management company for the investment stage. Then we also have fixed cost expenses for management company. So here we specify what are they, and then we specify how much we pay as a fixed cost during the operating activity of our project. Then we move to payroll of management company. Here we specify positions, salaries, and amount of people on different positions. Then we move to loan. So here we specify the amount of loan, the term of loan, interest rate, grace period for principal payments, grace period for interest payments. The loan is automatically linked to the moment when we start investment activity, the first investment activity of our project. Then we move to taxes. We specify the rate of revenue tax, the rate of profit tax, and the rate of payroll tax. And then all this story comes to the cash flow statement. Here it is, where we are able to see the structure of revenues, direct expenses, fixed expenses, payroll, taxes. Here we can see the result from operating activity. We can see how the business is slightly growing. So first of all, at first period we have some operating losses. Then we can see how the profit is growing. Here we can see how much financing, how much equity financing we need, how many loan we have. So we can see when we add a loan, and as a result we can see the total financing needed for the business. This is equity we need, this is loan we have, and then we can see the simple discounted payback period diagrams. We can start using different coefficients to adjust the level of revenues, the level of expenses. So first of all, you will, after putting in all this data, you will see your the financial efficiency of your business idea for the first time. You will just go up and start playing with all these coefficients, these coefficients, and you will get acquainted with your business idea for the first time. So while playing with all these stuff, you will see for the first time what is the payback period, simple, discounted, what is the net value, what is the net present value, what is the profitability index, what is the internal rate of return, how much financing total is needed. And then, for example, you would like to see how stable your business idea is, and you can for example you can add a coefficient of sensitivity analysis. Here, press enter, and now you can see, you can test what will be the financial efficiency if direct expenses will go up or decrease. What will happen with net present value, simple, discounted payback period. You just press sense button and see what will happen, how stable your business idea is. Let's do that. And now, for example, you see how your business breathes if if the direct expenses increase or decrease. Now you can, for example, go back and add this coefficient to any parameter of inputs, so revenues, expenses. So you just can, first of all, we are deleting this coefficient from here, and for example we would like to see we would like to add this coefficient to pricing. The step of changing the parameter will be, for example, 20% step. And then I'm just pushing this button to see what will be how business idea is stable if we increase or decrease pricing. So now you can see how you can add this parameter of sensitivity analysis to any inputs and test your financial efficiency, what will happen if the revenues will grow, if expenses will grow or increase or decrease. So this will show you many interesting things, many peculiarities about your business idea. You may think that it is time to rethink some inputs, and it's a good time to do that before you real start of your business. So if you found this video valuable, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch. Order financial model from scratch for your business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.